Good afternoon. This is Jim Barlow with OakTree Strategic Leverage. And there's our title for today. 4 questions that could change the way you think about retirement. This is a new webinar, um, new ideas, and I think it could be very, very helpful for a lot of people. And I believe it should be a lot shorter than other webinars I've done. Hopefully you like it. Anyway, let's get started. Sounds intriguing, doesn't it? 4 questions that could change the way you think about retirement. How successful retirees think differently about risk, taxes, leverage, and protection. That's kind of the 4 words that are going to kind of lead to those 4 questions: risk, taxes, leverage, and protection. The traditional question, how do I earn a high return? I'm sure you've asked it. We all have asked it when trying to do better with our investments. That's where most people start, and it's where retirement planning begins for everybody. A better question. See if you think that this is true. What are the things most likely to cause my retirement plan to fail? I believe this is the place to start. Make sure you have a plan that can't fail. I've designed what I call the inversion wealth framework. We start at the bottom of the pyramid. Inversion. Inversion is to look at things upside down, backwards. Look at the fundamentals, decide what could be where could we lose and avoid ruin. This is a belief, a philosophy that is everything you follow is by this. Then you start looking for a structure that is in line with inversion, or you build a structure. Because once you have a inversion, you protect the downside and you build a structure to work on this, then you can leverage this return. And last, you let this thing happen. You have some patience. A short, not a great things people have in the investment world. Anyway, I'm going to show you how this all comes together. The inversion wealth framework. The 4 questions. We're going to start with number 1. What if you could participate in market gains without exposing your retirement assets to market losses? That's probably a nice formal way to say, I don't want any downside. How can I have market returns with no downside? Some of you listening are saying, well, no, that's not a reality. Let me show you. Retirement. Retirement changes everything. You're no longer accumulating, you're withdrawing. Losses are permanent, they're not temporary. You can't let something go down and then just ride it back up. You might need to be liquidating when it's down. Sequence risk is essential that you understand this, and it can destroy someone's retirement. Things matter more than timing matters more than average return. Um, wow, average return doesn't mean so much in retirement. Income depends on a structure, not the market. And I'll show you how that works. In retirement, you don't get paid to be patient. That's just reality. So let's talk about this sequence. I've got 2 retirees. They're experiencing the same average return, 0. but in a different order. So both of these people are starting with $1 million, withdrawing 50,000 a year. So the first client A, his first year had 20% return, second year 10%, third year 0, then the fourth year negative 10, and the fifth year negative 20. And for client B, I just reversed that. Negative 20, negative 10, 0, 10, and 20. A simple look at sequence. So the first fellow, oops, don't want to go too fast. So we're taking out the 50,000 per year, and we're growing it by 20% the first year, and that's how we end up after the 5 years, 748, 800. We're down $250,000, and we took out 50,000 a year. We're close to even, a zero return. We didn't get hurt. We just didn't have any growth in this example. But what about client B? This fellow went down a lot in just the first year, negative 20%. And at the end of his period of time, he's at 511,000 instead of 748. You can see how sequence was damaging. Client A has 46% more money, 46% more money than client B. In retirement, sequence risk, you just can't, if you can eliminate downside, you can enjoy your retirement. So avoid ruin. This matters more than chasing returns. Great investors survive. So we're going to show you a different approach. It's the cash value life insurance policy. This is the structure. You'll see why this structure does the job it does. We're going to have index in interest crediting strategies, potential market link growth, but with no downside. Your bad years is a zero return, not negative 20, not negative 10, not negative 37 like 2008, and no direct market investment. So in an index universal life policy, they have this indexing strategy. Most of the premium after insurance costs is allocated to high grade bonds. This is the protection side, with a smaller portion used for buying index linked options. Let me show you. So out of an excess premium of $1,000, let's say 950 goes to the bonds. That will grow back to $1,000 in 12 months. That's how we're guaranteeing no loss. Because most of the money, well, a big portion of it, is in bonds protecting your principal. Then we have this small portion going into options linked to indexes you choose. If we had a higher interest rate environment, maybe instead of 950, maybe 900 is going to the bonds and $100 and going to the options. It's all based on interest rates and what will grow back to the $1,000. But this is how we have the zero floor, by just doing our market returns through options. So we're saying protection first, growth is second. That sequence is what matters, that makes the structure transformational. I'm going to show you index performance is a busy chart, a lot of numbers, but I built this last week to show you how these indexes work. The two major life insurance companies I use is National and Allianz. And you'll see the National and the brown on the top. There's 3 investment options, and in Allianz, there's 5. But let's just start with the first 2 columns. This is the Standard & Poor 500 index point to point. So it's a broad U.S. equity exposure. And they buy with these options as much to the market that they can. And it's so to have that zero, that base, with National, we can currently the cap is 11% with Allianz is 12.25. What the cap means is that's where you're capped. If the market does 15%, you get the 11, a National or 12.25. And there's how these two indexes have performed over the last 5 and 10 years. Notice the Allianz had a little higher return in both cases, and also interestingly, they have a little higher cap. Probably the major reason why they have a little higher return. Allianz is one of I think it is the world's largest insurance complex. And they actually do their own hedging, their own option buying, where nationally they use other entities to do that for them. That's probably the reason why the caps are different. That's one option. Now I'm going to go way over to the other side of the graph and look at those orange ones. These, notice 2 in Allianz, a volatility controlled index. These have been traditional in index universal life policies. And instead of a cap, you get a participation rate. And let's just look at the Allianz to start. So that PIMCO has a participation rate of 185%. So if the market this index does 10%, which is probably too high for my example, well, it is. But you'd get 185% or 18.5 instead of just 100 at 10%. Notice the other one, the Bloomberg with Allianz, has 190%. Different companies have different ways to decide what they can buy and do. And notice the National has the higher participation rates. These are the current participation rates today. And based on those participation rates, here'd be your averages for 5 and 10 years. Very nice returns, generally speaking, because you don't have the caps the other halves. So 2 different approaches, a capped Standard & Poor 500 or these volatility controlled funds. Fairly recently, those 2 in the middle, the futures with Allianz and the blended futures, Allianz wanted to have some options that we didn't have caps on, but that we could have a more aggressive fund and have a participation rate. Unfortunately, to do this, you don't get 100% participation. The blended futures, the multi-asset one has 95, which is close. And there's the 5 and 10-year numbers there. It gives a different approach than just the cap. But those 2 different companies, that shows you what kind of performance you can get with this zero floor. So that was our first question. What if you could participate in market gains without exposing your retirement assets to market loss? Well, you can. We've answered question 1. We've avoided market loss years, and we're participating in growth. in as much as we can purchase in options. Question number 2. What if your growth could accumulate tax advantaged and provide income that may be received income tax free under current tax law? Other, I've used the hedge words that compliance requires tax advantage. But let me show you what I mean by this. There's kind of 3 different tax buckets. There's taxable accounts, there's tax deferred, there's these tax advantaged. Let's show them to you. First, we have the taxable bucket. This is your bank account. You earn 10% or 5 or 4, and you pay taxes on the earnings. Same with CDs, money market account, or a broker's account that owns stocks. And we will go into long-term capital gain, but it's a taxable account. So you can make money in a taxable bucket. Or you can go with a tax-deferred bucket, which is traditional IRA, traditional 401k, 403b is the same thing, basically, but for schools and nonprofits. SEP IRA is Simplified Employee Pension IRA for self-employed small business owners, or a simple IRA for small businesses, or deferred annuities. This is tax deferred concepts. I've, in my investment career, I did a lot in tax deferred. In a minute, I'll tell you if I think I made a good move or not. And then there's tax advantage bucket. Roth IRAs and Roth 401ks are tax free. You're not getting the tax benefit today. You don't get to write something off, but it's going to be going tax free. I'm not going to we're not going to spend any time explaining Roth IRAs today, 401ks, but this is a bucket that becomes tax free. Health savings account with your employer, if that's available to you, say be sure to do it. I did in my different companies I was with. Or a properly structured cash value life insurance. And of course, I've already shown you that's what we're looking at. So let's talk about that properly structured life insurance. Oh, yes, I did want to say this. The retirement tax trap. Most retirees have substantial assets in tax deferred accounts. That's me. When it was time to, should I put it in the Roth bucket or the traditional bucket? I always wanted that tax savings today. I was pretty normal, and most people, that's where they have probably too much in. I have. So, life insurance. Life insurance was designed, first and foremost, to provide financial protection at death for the breadwinner, to protect that family so they can keep on living in their home or whatever. Because of its unique role in protecting families, the tax code has always provided favorable treatment during accumulation, distribution, and wealth transfer. But let me go over these points. The 3 tax advantages. Accumulation. Beyond the cost of insurance, any money that's going into the cash value of the policy is tax deferred. You're not paying taxes on the growth as it grows. This has been the case from when we started income taxes. I think it was 1918. We've always had this advantage. I've jumped over the middle one because I want to mention this here. The transfer. This is the death benefit. And with those same tax laws that are in effect, it's generally income tax free. I had to put in the generally because there are some exceptions to the rule, but basically, life insurance is going to the beneficiary when the owner of the policy, the insured of the policy dies, it's going to the beneficiaries tax free. The government has always wanted that to be the case. Um, they want a way to protect the family. And why would they want taxes when this family's going to struggle anyway if they, whatever the situation is? So, tax free benefits. It becomes tax free when the owner dies. Accumulate tax deferred. On death, it goes to the beneficiaries tax free. Now I'm going to cover this middle one. If you're the owner of this policy, you can have access to the cash value by policy loans, meaning you have a let's say you have $1 million in cash value and you pull out 100,000. Well, you still have $1 million in cash value, but you have also a debt of 100,000 with the insurance company, and you'll pay interest to the insurance company. But you're not paying taxes. You're just borrowing the money. And that's the beauty of a retirement plan with life insurance. One vehicle, tax advantage during life and at death. I want to talk about a rider we add to all these policies. Let me be kind of a little negative. So let's say you had that $1 million of cash value, and let's say you put in let's be dramatic, and you put in 100,000, and it's grown by 900,000 that you've never paid taxes on. Then you borrow money out, and let's say you pulled out 800,000 in your retirement. You're borrowed from it, and you still have not paid taxes. But when you pass away, it's solidified. It's all tax free. But if you decide to, I hate this company, I hate this policy, and you want to close it out, you'd be taxed on the money you pulled out. So we have a rider to all these policies that prevents a policy from substantial loan from lapsing later in life, triggering a large taxable event. We have a loan protection rider, so we leave something in this. We won't take all the money out. We leave something in there, even if people pull a lot of money out, so that it won't per se blow up on you. So traditional investments: tax while earning, tax when sold, tax when distributed. Properly structured life insurance: tax deferred accumulation, tax free death benefit, tax free access by borrowing. This is the structure that's really cool. Um, it's not what you earn, it's what you keep after taxes. So we've answered question 2. After tax income matters more than pre tax returns. You can take your retirement out tax free. If I didn't explain that well, give me a call. I'm happy to go over it a little more thoroughly. Third question: what if institutional leverage could potentially increase your retirement income 60 to 100% compared to an unleveraged approach? Ooh, leverage, borrowed money? The wealthy think differently about leverage. Banks use leverage. That's the whole basis of the company. Corporations use leverage. They all have bonds that they've issued. They borrowed money. In fact, the companies that don't borrow are going to be taken over in some sort by entities that can see where they're making mistakes. Real estate investors use leverage. Leverage is not all bad. There's speculative leverage, there's productive leverage, there's safe leverage. The dangers of leverage: margin calls in a brokerage account, personal guarantees, outside collateral, forced liquidation, excessive leverage, loss of timing control. You can have too much leverage. We don't want that to happen. We don't allow it to happen. Leverage becomes dangerous when it creates possibility of a forced decision at the wrong time. What makes leverage powerful? If you have a long time horizon, you've controlled the risk, you've got compounding growth, tax advantage accumulation, no forced decisions. I'll show you a number in a second. They'll help you along with this. So I haven't mentioned the name Kaizen, but this is our structured approach to institutional leverage. Kaizen has a client contribution, has a bank contribution about 3-to-1. We put it in a trust structure so that it's in yours. Your life insurance policy is in a trust set up in your name. Then we have a overseeing trust that does the borrowing. I'm not going into my charts that I usually do, but I'm just giving you the overview. But the way we've set it up, there's no margin calls. There's no outside collateral. There's no personal guarantees. There's never going to be a time someone calls and say, you've got to put more money in because of the leverage. We have it controlled and reasonable. So if you're putting in 100,000, we're going to get a bank to put in about 300,000. If you're putting in $1 million, we'll have a bank putting in 3 million. It's still very safe in your behalf. Totally. So I've got a shorter case study. So I've got a male age 40 contributing $25,000 for 5 years. And Kaizen is just 5 years. If you can, with some companies, it's an annual payment. Some companies you can set up for a monthly payment. So in this example, 25,000 for 5 years, total out of pocket 125,000. We want the life insurance. We do, but we also want the income later on. So the age 40, we want to start income at age 65. We want to make sure this lasts all his life. So I did 65 to 100. I put excellent health, non-smoker. Do you have to have excellent health? It could be average health, and Kaizen still works. I've used a growth rate of 6.84. This is regulated by the National Association of Insurance Commissioners. And I did the numbers just the other day, just the 15th, was that 3 days ago? We have an illustration software that's pretty cool. Anyway, here's my case study. At 65, at that what was the number again? 6.84% average. Kaizen our policies have averaged higher than that, but at this regulated number, this would give you an income. This person would have an income of 72,000 starting at 65. By the time he hit 100, he would have pulled out 2,592,000. And that was from a contribution of 125,000. And that with no downside, tax free, 2,592,000. Most people say that's a little too good to be true right there, but that's just using those numbers, that's 6.84. If you did this without the leverage, same policy, same company, but didn't do the borrowing, your income would be 46,000 instead of 72. Actually, that comes out with a 56% more income because of the leverage. And in the illustration software, there's the total for the self-funded. Notice, let's see, about 900,000 something plus more money just because of the borrowing. And if you just did this in the regular investment world, paying taxes as you went, got the same 6.84% return, you could pull out from 65 to 100, $26,615. That's a whole lot less than 72 or 46. We have no downside. Question number one, market returns, tax-free. And again, looks too good to be true. That's 270% more income. Here's the very first policy ever issued in 2012. There's an annual statement comes out for this person. This is one of the owners of NIW, the designers of Kaizen. She bought the first policy, and she gets an annual statement on June 27th every year. This is last year's. She's averaged 7.85% for every year from 2012. Not a bad return. She's also paid on the borrowed money an average interest of 3.95. And then I've just done the calculations. The spread between the 7.85 to subtract 3.95 is 3.9. She's made 3.9% on the borrowed money. 7.85 on her money, 3.9 on the borrowed money. That's what we like to do. We like to use other people's money to make money, the 3.9 on the borrowed money. That's kind of one of the beauties of Kaizen. Now, the long-term historical average of the S&P 500 is right around 10%. So I put that down so you can say, Jim, 10% is higher than 7.85. And I said, yeah, I get it. But remember, that's tax advantage, that's tax-free. So if we say taxes were just 25%, and it could be 35, 37 in our country, then 75% of the 10 would be 7.5. So the 7.85 is competitive, tax-free. Kaizen is working for people all over the country from day one on the very first policy. Here's some data that the founders of Kaizen is NIW. They did this analysis. They looked back all the way to the 1930s, and there's been no rolling for 15-year period of time that a spread has been less than 2%. Remember, there's 3.85, was that? Yep. So they're basically saying by this conservative leverage amount over a pretty long period of time, we plan to average nothing less than 2% on the borrowed money. Are you going to have years that the market's negative 20, so you got a zero and you still pay the interest? Sure, but not over a 15-year period of time. Question 3. What if institutional leverage could potentially increase your retirement income by 60 to 100%? Oh, I had 270, didn't I? To an unleveraged approach. Question 3 answered. Leverage can be a powerful when properly structured. Fourth question. What if the same strategy also provided life insurance protection, chronic illness benefits, long-term care benefits, and disability protection? Well, it's a life insurance policy. You get all those things along with this retirement plan that's performing well. And day one, you purchase policy, you immediately have a death benefit. What a way to have your life insurance and have it do something else even better. And different companies have different amounts, but the National has all of these. National Life has the disability protection, chronic illness, critical illness, terminal illness, long-term care benefits with potential. The way they do this with potential access to your death benefit while you're living. So you've got you're not going to do a come fund me account once you have a policy like this because you have money available for these important deals. This is the slide we already put in, but I put it in again in this life insurance section because without life insurance, we had an income of $26,615. With life insurance and the leverage, we have an income of $72,000. What did our life insurance cost us for all those years on the death benefit? Ultimately, it didn't cost us anything. It gave us a higher return. Life insurance gave us a higher return than just investing. Wow. Um, that's pretty cool that you get this fourth question. What if the same strategy also provide life insurance protection, chronic illness, long-term care benefits, and disability protection? It's answered. A retirement strategy designed to address both opportunity and protection. Here's the 4 questions. What if you could participate in market gains without exposing your retirement assets to market losses? What if your growth could accumulate tax advantage and provide income that may be received income tax-free under current tax law? What if institutional leverage could potentially increase your retirement income by 60 to 100%? And what if we could have life insurance with all the long-term care benefits in addition? I think that's kind of cool. Well, so what's the final question? What if the biggest risk isn't market risk? What if it's market loss, behavior mistakes, poor structure, taxes, health events, longevity risk? There's some real risk to retirement. You've got to have these funds available, and we've taken a lot of the risk away with Kaizen. The inversion wealth framework. This is my approach. Find ways to protect your money. Find a structure that can help you do this. Then you can leverage. If you can't find that structure, don't leverage and take risks you can't take. And then let patience build this thing for your retirement. The inversion wealth framework. That was kind of fun. Most financial plans focus on returns. The best plans focus on outcomes. The 4-question recap. Can I reduce downside risk? Yes. Can I improve tax efficiency? Yes. Can I use leverage intelligently? Yes. Can I protect my family and myself? Yes. Could these 4 questions change the way you think about retirement? Oh, I think it can. And that's it. I've got a couple QR codes. The the bottom one is goes to a log a a landing page, I'll call it, which has videos. It has chapters, 10 chapters on Kaizen, about the leverage, and you can be a genius on Kaizen all on your own because of this landing page. Uh, and I won't know you're there. I'm not going to send me an email. So, oh, he's into the landing page. If you like it, I can help you with Kaizen. The top one is a QR code for that older client who wants to set up Kaizen for maybe their children or their grandchildren. So this is kind of with a special slant. We haven't covered that approach today. I'm going to try to work on this 4 questions for that too. Don't think I'll have it for my next webinar, but I'll be working on that. But there's 2 QR codes that can help. And there's my phone number, there's my email, there's my website. I've got a lot of stuff on there that's helpful. And just want to help. Reason I'm doing this is because I enjoy helping people. I'm not trying to make a lot of money selling Kaizen, but I'm hoping to help people and get ready for retirement, have a better retirement. And that's our webinar today. Oh, I want to make this shorter than that, 41 minutes. Well, maybe next time. Have a great afternoon. Hopefully you had a chance to get those QR codes down so you can look at it. But have a good afternoon. Bye.